Hello everyone and welcome back for episode 13 of Odds Are, your S&P 500 weekly market forecast. Alright, we did not put out a show last week, and I will get into that a little bit more later on, but to avoid breaking any further from tradition, let's start off by taking a look at the relative view. Alright, you can see here the relative view, and you see there's a lot of activity going on because we have the relative points from 2 weeks prior and then the price action for the last 2 weeks. So it extends beyond those lines. But rather than cluttering it with 2 weeks worth of bars, let's just take a look at what happened when we did our previous forecast 2 weeks ago. You could see that the market did in fact breach below and above the breach points of 4160 and 4207. So we had that double breach in the week, and then it stayed, within the expected settlement range. So nothing out of the ordinary there. We did notice here, as we're now fast forwarding into last week, that the market did break down hard towards, the lower ranges, but ended up coming right back up. And so in hindsight, we're looking at 9 days ago, we were at 4172, and now we're at 4169. So really a net drop of 3 points from 9 days ago, even given all that increase in volatility and that big drop and the fear of inflation and everything going on. We're only 3 points lower than we were 9 days ago. And so we are still very high, relatively speaking. We're still far away from that parabolic SAR level, but it is rising. So let's move on and take a look at the moving averages. All right, your short-term moving averages for the week ahead are now in bearish territory, which is not surprising given the strong downward movement that we experienced last week, even, despite the bounce back at the end of the week. If you would have had the moving averages up on the screen last week, if we would have put a show out, you would have seen that it was neutral. So it went from bullish to neutral to bearish, which is the pattern that we would expect. And now if the market does come back down, we would expect that to continue in bearish territory, and eventually the medium term moving averages would flip to neutral and then bearish, and et cetera, et cetera. We have not seen three red labels back to back in quite a while. I mean, for us to have bearish short term, medium term, and long term, we are talking about a very, very, very deep recession. But we've been there before, right? And so one of the things that we look at the market and understanding that there are cycles, we just have to be prepared for when that happens, because things are not going to stay green all the way across all the time. But let's look now at this week's breach points. All right, so we've got a 40.57 breach point on the downside and 42.65 breach point to the upside. And again, we closed at 41.69. You'll notice that this range is a lot wider than it has been in previous weeks. And that's because as the volatility has increased, the breach points are going to adapt, accordingly. So they're going to expand and contract along with the price action in the market. And so we still have a high 81.36% chance that we're going to have a breach of one of these 2 points. But what's interesting is when we put the settlement range on in a few slides here, you're going to see that we've got a complete flip of the relationship between the breach points and the settlement range. So we'll take a look at that here in a second. All right, next thing you're going to notice is that the parabolic SAR has gone up to 39.88, so getting closer to that 4,000 critical level there. You will also notice the addition of another point down here, which is at 39.38. And that's actually an oversold signal, and the reason is because in the past 2 weeks we've had a lot of downward movement. And so eventually the market usually kind of takes a breather, right? This is where the buyers step in and try to buy the dip, and whether that succeeds or fails is yet to be determined. But in this situation, historically, the market will not continue to go down with such strength. Now it can, I'm just saying the historical tendency. So based on that tendency, we are looking at a oversold limit of 39.38, meaning we do not expect the market to go down below 39.38 in the next week. And historically speaking, there's a 92% chance that the market will not go below this level. So 92% chance that the market will not go below 39.38 in the coming week based on the previous price activity. All right, let's add in now the expected settlement range. And we have, you see, the 40.59 and the 42.47. So in previous weeks, we've always had the breach points be within the expected settlement range. And so the idea was that we could reach one of those points, still be in line with the expected forecast, and then also stay within the expected settlement range. This week, that's kind of changed. And so it looks like there's a high probability that it'll reach one of those points to the outside, the red lines, but there's still about a 79% chance that it'll stay within the expected settlement range. So that could play out with the market reaching a point and then coming back, whether that be up and then pulling back down, or going down and then bouncing back up. We've seen that before. It's still very, very possible. The other thing to note is that with the breach points getting wider and wider, right, eventually that volatility is going to do one of two things. It's going to continue to spike, or it's going to calm down. And if it calms down, then I would not be surprised if the market did not breach one of these points. Again, we're talking in probabilities here. So 82% sounds, or 81.36% sounds great, but it's not 100%. So we'll watch that in the coming week and see how this plays out. My personal feeling, I'm looking at a push more towards the 40.57 level. I think we're going to get back down there to where we were, and then it will possibly get close to that 4,000. I think that the magnet effect still works both ways. We're going to maybe get closer to that 4,000 mark and then come back up above 40.59. But we'll see how that plays out. All right, let's add all those things together, and we're going to take a look now at the relative view for the following week. You can see that big gap now. You see how spaced apart those are because of the volatility. You see the breach points and the settlement ranges, and way down there you see the 39.88, and even further down you see the 39.38 oversold limit. So that's where we're expecting the market will not breach below that. So I'm looking at that area below the settlement range, the lower settlement range, and the lower breach point, and the parabolic SAR. That range right there between 39.88 and 40.57, that's kind of my target. That's what I'm thinking for this week. We're going to get into that range. Now, whether we break below it or whether we bounce back up above it is yet to be determined, but that's what I'm kind of seeing this week, and hopefully that helps. All right, let's move on to didn't see that one coming. And on this one, this is not related to price action. This is relating to proper planning and trading discipline. All right, so the good news, even though I wasn't able to get a show out last week, I was still able to make sure I had all my positions taken care of, all my stops were in place, I was able to monitor the markets, everything went smoothly on the trading side. But that being said, I feel like I could have been more disciplined about planning for the release of the show. And so what ultimately happened, we took a family vacation, and it was wonderful, it was great, it was fun, but there were certain spots in the beautiful landscapes that we were at where there was no signal. And it was a very, very fast-paced trip. There was a lot going on. Needless to say, you've probably been there before, did not have a chance to actually get a show out. But we're kind of where we left off 9 days ago, so that's all I'll say about that. But trading discipline extends to more than just the trading actions that you take. It has to do with your preparation for the trading day. It has to do with all the things that are a part of your routine. And for me, this show has become part of my weekly routine, and I am definitely going to try my best to continue, doing this every week going forward. So, lesson learned for me, and hopefully a little something for you as well. All right, and we will wrap up with the quote of the week. And so the quote of the week is by Victor Sperandio. Hope I'm not mispronouncing that. He is the CEO of Alpha Financial Technologies. And so what Victor says is, the key to trading success is emotional discipline. No, that's not a coincidence. I put that in there intentionally. If intelligence were the key, there would be a lot more people making money trading. And how many smart people do you know? I mean, we have friends, family members, we have, people that are either doctors or lawyers, engineers, scientists. I mean, there are people that, school teachers that are brilliant in their subjects. It doesn't really matter the field. You have people that are very, very smart and good at what they do. Does that mean they are all suited for trading? Absolutely not. And then you have other people that did not have, what we would consider traditional schooling or training, and yet they are very, very good at what they do in trading the markets. And I think that can be attributed to just that notion of discipline. So if you can find a system that works for you, if it really resonates with your personality, if it's something that you have a passion for, and you just know that you can stick to the plan, then it doesn't matter whether you have a piece of paper framed on a wall. It doesn't matter if you have X number of hours of trading experience. It doesn't matter if you've ever traded before. This is something that, especially now with the mobile apps and the low cost and low barrier to entry in the market, you can start off with $100, and you may not get rich. You're not going to become a millionaire, in the next 6 months or a year, but getting that practice, getting that discipline, getting that experience is something that is within reach for all of us. And so I encourage you all, if it's something you have a passion for, please don't hold back. Don't feel like you need a certain educational background or certification to do so. This is something that we can all participate in, because at the end of the day, these companies, they rely on us to purchase their goods, and we are the ultimate arbiters of what the value is for that company. If a lot of people tomorrow wake up and decide that a certain company's products are no longer what they need, that company's stock is going to go down. And if we put our money, behind a certain company, whether it be by buying stocks or buying their products, they're going to go up. So we already play a critical role in this market. We just don't know it, or at least some of us don't. So with that note, I will leave you guys. Enjoy the rest of your week, and we'll see how this one plays out. Take care.